Welcome to The Explainer. Today, we're tearing into the notoriously dense accounting rules of IAS 20, and we're going to track the entire life cycle of a government grant from start to finish. If you've ever found yourself totally lost in the weeds of deferred income and net asset presentations, don't worry, we're going to break this all down logically together.
Okay, let's dive right in. Here's our roadmap for today: recognizing grants, sorting income versus asset grants, choosing between gross and net presentation, and finally, accounting for refunds.
Section 1. The Handshake. Recognizing Government Grants.
Here's the harsh reality. Just because a government promises you a big check, you can't go celebrating and throw it on your balance sheet just yet. Think of grant recognition like a strict two-factor authentication system. Step 1, you absolutely need reasonable assurance that you're going to satisfy the conditions attached to the money. And Step 2, reasonable assurance that the grant will actually hit your bank account. Both of these boxes have to be checked at the exact same time before you can officially call it receivable.
Moving on to Section 2, the sorting hat, income versus asset grants.
So you've passed the two-factor authentication. Now what? Well, we have to sort the grant based on its ultimate purpose. We've got two main buckets. First up are grants related to income. You'll often hear these called revenue grants. These cover your day-to-day operating expenses, things like subsidizing payroll or providing free medical services. Then in the other bucket, we have grants related to assets, or capital grants. These are strictly for big-ticket capital expenditures. Think constructing a brand new hospital. Let's zoom in on those income grants for a second. When you finally get that money, you absolutely cannot just recognize all that income on day one. Nice try, right? Instead, we create what's called a deferred grant income liability account. It's essentially a holding pen. It keeps the funds securely parked as a liability while you roll up your sleeves and actively work to satisfy the government's specific conditions over time.
So the real million-dollar question is, how do we empty that holding pen? Well, you slowly release this deferred grant income into your profit and loss statement, and you do it to perfectly match your compliance costs. Say your costs to fulfill the grant's conditions are $1,500 in year 1, $1,000 in year 2, and $500 in year 3. Your grant income is recognized in that exact same ratio. Oh, and don't forget, you have to slice this liability on your balance sheet. The portion you'll recognize in the next 12 months goes into current liabilities, and the rest sits in non-current.
All right, Section 3, the bookkeeper's dilemma, gross versus net presentation. Now, for grants related to assets, like building that hospital we talked about, accountants have to choose between two completely divergent paths. Path 1 is the gross approach. Here, you keep the asset value and the deferred grant liability totally separated on your books, and you just amortize the grant income over time to match your depreciation. Path 2 is the net approach. This is where you take that grant and deduct it directly from the asset's initial cost on day one. You are literally shrinking the asset's value on paper, and from then on, you only depreciate that new lower net amount.
Let's actually run the numbers on a 6-year asset to see how this plays out. Imagine you have a $90,000 asset and you get a $30,000 grant. Under the gross approach, you're recording a $15,000 depreciation expense and $5,000 in grant income every single year. But under the net approach, your asset is now only worth $60,000 on the books. So your depreciation is just a flat $10,000 expense, and there is absolutely zero separate grant income shown. But look at the so what factor here. Regardless of which method you choose, the net impact on your profit and loss statement is exactly the same. It's a $10,000 net expense either way.
But wait a second, what happens if the grant covers literally 100% of the asset? Does the asset just vanish? Well, IAS 20 has a fascinating little edge case for this. If applying the net approach wipes out your asset's value completely, bringing it all the way to zero, you are required to record the asset at a nominal value of exactly $1. You simply can't let a physical asset entirely disappear from your books. Which brings us to Section 4, the repo man, accounting for grant refunds.
So, what happens if things go south? What happens if you break the rules? If you drop the ball and fail to meet the conditions attached to your grant, it isn't just a slap on the wrist. The government wants its money back. And frankly, the accounting for a refund is where things get really interesting.
If we're talking about income grants or asset grants where you use the gross method, the refund rule is actually pretty straightforward. Step 1, you just drain whatever balance is left in your deferred grant income liability account, bringing it right down to zero. Step 2, if the amount you have to refund is bigger than what you had sitting in that account, you take that excess amount and hit your P&L with it as an immediate expense.
Now, if you use the net method for an asset grant, get ready for some serious mental gymnastics.
Remember, under the net method, you artificially shrunk the asset's cost on day one. So when it's time to refund the grant, you have to completely reverse that original cost deduction to pump the asset's value back up. And here's the real kicker. You also have to immediately catch up and recognize the extra depreciation you completely missed out on recording while the asset's value was suppressed.
Let's ground this with a concrete scenario. Say we need to refund a $30,000 grant after exactly 1 year on a 6-year asset. Because we use the net method, our asset's carrying value is currently sitting at 50 grand. But without that grant, it would have been 75 grand. To bridge this gap and recognize the refund, we have to add $25,000 back to the asset account, and we have to record a $5,000 catch-up for that depreciation we missed out on. Add those together, and it balances out perfectly to the $30,000 grant payable we now owe the government.
And this brilliantly illustrates what the final consolidated year-end adjustment looks like. When you merge that $25,000 asset add-back with the current year's standard $15,000 depreciation credit, and then combine the $5,000 missed depreciation with the current year's $15,000 expense, you get this beautifully clean final journal entry. You're left with an asset account debit of $10,000, a depreciation expense debit of $20,000, and a grant payable credit of $30,000.
To wrap up this explainer, I want to leave you with this provocative thought to ponder. Are government grants really free money, or are they just highly conditional temporary liabilities waiting for a misstep? By mastering this entire life cycle, from the strict two-factor recognition all the way to the gymnastics of a net method refund, we've taken a notoriously dense accounting standard and turned it into a highly logical story. Keep applying these frameworks, and I'll see you in the next explainer.